Wall Street's top investors are bracing for the biggest stock market crash of our lifetime, with the tech bubble burst leading the meltdown that will start over the next few weeks. The stage is set for an epic financial disaster, and after the explosion, we will be headed to the worst economic depression we've ever faced in the history of the United States. That's what one of the most successful investors and market strategists of modern times is telling us. Harry Dent, the founder of HS Dent Investment Management, is warning that we're about to enter some exceedingly difficult times. But most people don't even know what's truly going on. Months ago, he predicted that stocks would crash by July. Even though some major stocks have crashed in September, the correction wasn't nearly as sharp as the 80% prediction he shared at the time. That's why some people started to dismiss his forecasts and believe this bull run is going to last forever. But the truth is that he only got the timing of that prediction wrong because he wasn't expecting the Federal Reserve to actually follow through with its insane plan of issuing additional trillions in printed dollars to pump even more liquidity into an already flooded system. Just like him, many were doubting the Fed would do something so crazy, and many experienced market veterans also got their predictions wrong back then. No one could imagine that the Federal Reserve would cross such a threatening line, one that could jeopardize the future of our nation for decades. But guess what? It did it anyway. Our politicians and policymakers have made terrible choices, and they didn't spare a single moment to consider the long-term consequences. They fueled the growth of the bubble and incited investors to take on huge risks without being honest about potential repercussions. But as Dent noted, you can blow up a balloon only so far, and then it pops. The government tried to keep this bubble going no matter how ridiculous it is, he says. But this time around, additional stimulus won't help. Enough is more than enough. You can't keep something going just by printing money, an artificial stimulus, because it takes more and more to get less and less, he argues. You can't give an addict another shot to get him back up. He's been addicted to free money now for 12 years. Now, it's time for rehab, Dent says. And we already have proof that more stimulus cannot fix a terminally broken system. Our nation's GDP sharply collapsed right after more money was injected into the markets, when the exact opposite should have happened. That's the signal that we can't push this bubble any further. Money isn't preventing the slowdown in our economic growth anymore, and that is very bad news for stocks. The economy wants to go to sleep and refresh itself. It wanted to do that in 2009, but the government didn't let it finish the process. It says, in effect, we're gonna outlaw recession, downturns, and debt deleveraging. Well, I'm sorry. The economy disagrees with you, says the Harvard Business School MBA, further explaining that this is the longest time in modern history since the Industrial Revolution that the United States has gone without a recession to help purge the economy and make it more efficient by getting rid of failing companies, simply because the politicians have been too afraid of letting it slow down, because they thought they would end up losing support at the ballots. In a recent interview, Dent asserted that 21% of all U.S. companies are barely limping along and are doomed to bankruptcy in the recession he sees occurring shortly after the crash. We'll have the biggest recession or a depression of our lives next year, and the economy isn't going to get strong again until 2024, the investor alerted. At some point, the economy has to deleverage debt in zombie companies. Otherwise, it can't grow any further. The economy is dead, he proclaimed. It's been overstimulated. We can't squeeze any more growth and juice out of this orange. It is dropping like a rock, he insists. Dent correctly predicted Japan's 1989 bubble burst and recession, also the dot-com crash, and predicted the populist surge that made Donald Trump president. Now he's saying that stocks are on their last legs, reaffirming that the market will face an 80% catastrophic drop. First, it'll crash by around 50%, he argues. The remaining 30% will come as investors start to feel the impact of rising interest rates. The most critical problem we face now is that the market bubble is expanding. At the same time, the economy is rapidly slowing, and you can't wake the economy up with another cup of coffee. It's just gonna go to sleep and pass out, Dent says, citing that GDP growth declined from 6.7% in the second quarter to 2% in the third, which gives us solid evidence that another recession is looming. When the stock market crash finally hits, it's likely to plummet further from the highest point to the lowest point compared to any crash in history, including 1930 to 1932. Dent explains, it's been put off for so long that when it finally goes, it's gonna be harder and faster than usual. It'll also be the biggest first 2 to 3 month crash, bigger than the first 1929 crash or the first 2000 crash, he continues. The expert revealed that a couple of months ago, his indicators estimated that after the bubble burst, the market would initially drop by 40% in the first months. But after reassessing the current market conditions with his team and releasing a new analysis, his indicators are now saying it's gonna be over 50%. He is not alone in this forecast. In recent weeks, even Bank of America strategists said that investors are overestimating earnings growth. In fact, the bank said that speculation is far higher today than during the dot-com bubble. And that's setting up the market to a 25 to 50% correction as investors dismiss the bigger picture. The Fed starts tapering its bond purchasing program soon, and that will be the pin to pop this gigantic bubble. On the same note, the founder and partner of Oxbow Advisors, Ted Oakley, said in an interview with Kitco News that the greatest threat facing investors today is the unsustainable stock market valuations that are about to revert. If we take a look at the standard deviations of valuations relative to where the market is, it's clear that stock prices should go back to where they belong, which is at least 50% lower from current levels. He stressed that a 50% break is just a matter of time, and it shouldn't come as a surprise when it happens, because anyone with basic common sense can see it coming. The expert also highlights that this is an everything speculative bubble, and the higher risks are in the stock market, but real estate and equity aren't immune. Private businesses are selling for speculative prices, but the markets are selling for prices that actually have never existed before, he said. Until some time ago, all the market dips, even micro dips, were almost immediately bought by retail investors who entered the bubble during the GameStop AMC frenzy that drove junk stocks to soar 300% in a matter of days. That reinforced the delusional loop of optimism in the market, as zero-hedge analysts observed, but this loop may finally be reaching its sell-by date. Given that most stocks are priced for perfection, if anything goes wrong with the economy, whether because of an aggressive interest rate hike or an external shock or even a black swan event stemming from trouble in the global markets, that will break the entire chain of dip buying and options-based speculation and spark a tech bubble burst overnight. Those who will suffer the most are the ones who have been persuaded by the Reddit gamers to enter the bubble with no preparation. They have never experienced a crash before, and they are definitely not ready for a down market. The 1987 crash is a great example of how high risks can get because of this unrealistic optimism. The market is peaking. It'll only take a single shock to reverse this trend and trigger a sharp sell-off. The odds of a meltdown are increasing by the day, whether people believe it or not. There's a famous Warren Buffett quote for times like this: "Be fearful when others are greedy, and greedy when others are fearful." Needless to say that today's stocks are extremely overbought because of greediness. Investor euphoria has gotten out of control, and rampant speculation is heightening the risk of disappointment. Lance Roberts, the chief investment strategist at Real Investment Advice, told Business Insider that the market is being pushed to the limit and nothing good will come out of this market mania. Roberts said, "Over the last month, investors pushed the stock market to extremely overbought, extended, and deviated levels. Currently, the deviation from the long-term bullish monthly moving average is at the most extreme since 1997. Furthermore, Roberts continues, the stock market is now highly overbought, which has typically preceded more significant market corrections. He cited 3 more signals that can tell when the market is due to take a turn for the worse. First, investors are over-allocated to equities. Last month, Goldman Sachs noted that allocation to stocks in portfolios is at 52%, much higher than during the dot-com bubble. This means we have a much sharper downward volatility, Roberts explains. Second, investors are showing no signs of fear, as evidenced by the record low number of put options being bought, he outlines. Put options allow an investor to profit when the market falls and are an indicator of cautiousness or bearishness. Investors believe the risk of a correction is non-existent at the moment, in spite of the record run-up that stocks have had over the last year and a half, he added. Finally, despite this unprecedented market run, real economic growth and consequently company earnings are due for a weak period ahead. But investors aren't pricing this in just yet. Roberts also pointed to 3 indicators that can mark a turning point for stocks. They are 1. The yield curve inverting, meaning shorter duration bonds have higher yields than longer duration bonds, signaling low confidence in the long-term economic outlook. 2. The Federal Reserve tapering asset purchases. And 3. The Fed raising interest rates. The bad news is that the first one is already happening, and the second and third are weeks away from starting. In short, there's essentially no way around it. Just about every economic recession and market meltdown America has ever faced has been sparked by rising interest rates. Whenever interest rates rise more than 2%, a downturn follows, and the coming downturn is going to be the greatest in history due to the extraordinary magnitude of this bubble. At this point, everyone can see that a stock market crash is coming. Everyone is already expecting it. And considering the series of warnings making the headlines over the past few weeks, that shouldn't come as a surprise for you either. Get ready for the worst while you still can.